The jobs report and Trump tweets, right, about is what's really most important, because that really speaks to the Fed. Apple doesn't speak to the Fed. Apple's its own issue. It's its own. You can talk about Apple all day long, but in terms of what policy is going to go forward, the Trump tweet and the China trade and the strong jobs report and potentially the strong wage number is, I think, what kind of spooked the market. Besides Larry Kudlow coming out and completely denying what Trump said the night before about, well, maybe not so sure in trade, which certainly sent the market from, the S&P from plus 30 to minus 30 in a relatively short period of time, right? And so now it is Friday. We're going into the weekend. Elections on Tuesday. So there is that nervousness building as we go into the weekend. So I'm not surprised at all.
Let's play a game, Kenny. Scale of 1 to 10. 10 being super important, 1 being irrelevant. How important are the results of the midterms on Tuesday for the stock market?
I think it's probably an 8. Because depending on what happens, if the Republicans maintain control, I think the market takes off. If you get the split Congress, I think the market just turns. If you get a Democratic win on both sides, I think the market absolutely goes lower.
Oh, that was a quick summary. Michael Jones, do you agree?
Yeah, I think he's pretty much so nailed it. I mean, yeah, the market's expecting a split House in the Democratic camp and Republicans for the Senate, and it's a non-event if that happens. Democratic sweep is so hard to imagine, though, given the uphill battle they have in the Senate. If it did happen, I agree that it would be such a shock to the market that it would be a bad day. A more likely thing is the Republicans are able to hold on. If that happens, then, yeah, we're probably off to the races because it puts another tax cut on the table. One thing that we need to keep in mind, though, is as good as it might sound for equity investors, another tax cut is really bad for bond investors. We've broken through 320 today, and it would be bad for the bond market should the Republicans hang on.
Yes, but Michael, wouldn't that then also be then good for the stock market?
Yeah,
Money out of bonds into equities, or I guess into a stock.
Yeah, the funny thing about the market's trading patterns for the last several months has been the market has been really freaking out about the Fed raising interest rates. And we've looked at this extensively. And historically, when the 10-year Treasury has gone from a trading range of 1.5 to 2.5 to a trading range of 3.5 to 4.5, which is where I think it's going, historically, PEs have gone up and the market has rallied. Because the only reason rates were that low is because something was broken in the economy. You fix that, you're allowed to, you can sustain higher interest rates. The market's way more pleased with that than they are worried about rates going from super low to still pretty low. The problem is the market's going to take some time to buy it. We've had rates at 0 for 10 years. People are freaked at the notion of a 3% Fed funds.
So, Rick, this is all right in your wheelhouse. Go ahead and if you could, tackle which risks you think matter most to the bond markets. We're talking elections, Fed and jobs, trade wars, and what it's going to mean for the market.
On the trade war front, I don't know. I read the tweets. I read the story that was written that was inaccurate. To me, I don't know that. Yes, it moved the market yesterday. I really don't think that's the big driving force. I still contend that most rational investors I deal with as sources and people I rub shoulders with think it will get worked out. And it's pretty hard. Listen, we're at 25,240 in the Dow. Granted, it isn't on its highs, but it certainly isn't ready to everybody to set their hair on fire. And with regard to making interest rates the antagonist in every equation, the real antagonist was they were too low for too long. We now have the, what do they call it? We need to lock those that are addicted, maybe equity traders in general, in a room, and they're going to sweat for a while. But the issue is not that interest rates are bad. It's that equity traders and many global investors have gotten used to an environment that can't possibly perpetuate itself forever. At some point, there has to be a rational approach to the level of money and how much governments restrict the actual marketplace from price discovery to give us a true risk metric for the cost of capital. And that is occurring, and there's no force on the planet that's going to stop it.
That's right. But, Rick, if rates go up, and we all expect that they're going to go up, stocks will have to reprice. Doesn't mean they're going to collapse necessarily. I guess it depends on the speed and the rate at which they go up. But
so
rates are going to go up.
So what you're saying is they were priced wrong. So they were priced wrong.
I think the
what's wrong with something going from wrong to correct? Exactly.
Absolutely nothing wrong. Absolutely nothing.
I would have. Kenny, there isn't anybody who has thought about the exit, not only from the U.S. side of central banking, but the global side, who's ever thought that equities weren't going to have a bumpy ride. I actually think it's much less bumpy than I envisioned at this point. And remember, right now, you have a new 51-month high on 30s. You're 1 basis point away from a new 7-year high on 10s, and you're sitting on a new decade high in 2 years. So the whole curve continues to firm.
Fair. Guys, great discussion. Wish we had more time. I'm sure we'll have more. Listen, the Fed has never raised rates and delevered, you know, a couple $100 billion a quarter in the history of humanity. So good luck to America. Michael Jones, Kenny Polcari, Rick Santelli, thank you all very much.